Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about Dixon technology and why I believe even at 8,000 rupees it is a very good buy. So let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position into any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Before I talk about Dixon Tech, here's a small request that kindly support me on Patreon. And once you do that, it will help me grow the channel. It will help you also ask me questions in detail. And once you get the $10 membership, you will have access to my portfolio, my watch list, and a number of podcasts that I put up on Patreon, at least 2 to 3 a week. Also, I put up a number of articles on different, you can say, companies as well as the markets. So you have a lot of things working on when you get this $10 membership. If you have a detailed market or company analysis and you want to talk to me, you can directly email me and we can work things out. Now about Dixon Tech, established in 1993, it is the leading electronic contract manufacturing company here in India. Very few peers currently on the listed space. They also manufacture consumer durable products like washing machines and so on and so forth. Boast of best clients in this business. The market cap is was of less than 5,000 crore. It has now swelled up to I think around 8,000 crores. The clientele includes CB Plus, Xiaomi televisions, Samsung phones, all washing machines, Geo set-top boxes, and now they are also going into Mobilio with a company called Mobilio for their manufacturing of COVID testing kits. So a lot of things going on with Dixon, and let's understand as to how the business is shaping up and why I'm so positive. If you look at the financials of the company, it was not very great for Q1 of this year. Sales dropped by around 55%. PAT dropped by 97% and came out with 1 crore of profit at least. Have just over 100 crores of debt, which is not huge. They've just taken this debt recently just for expansion, etc., and paying quite well at the moment. Return on equity of 26%. Operating profit margin has dipped a bit. It is at 5%. Normally it is in low teens. But to tell you frankly, their net profit margin is around 2 to 3%, and in a contract manufacturing business, that is what you expect. But the sales growth is going to be huge, and that is what I'm banking on going forward. So the performance. So the stock is up 4.5 times in the last 12 months. So the stock was at around 1800 rupees at the bottom in March, and it has swelled up to not March but about in September, October, somewhere there. Last year it was around 1800, the lows that were made, and now it has gone up to 8000, 8400. It is going up to 5x being from that bottom, consistently gaining market share and new customers. So this is the biggest positive, that they are gaining market share left, right, and center in the consumer electronic space, whether it is mobile phones or LED televisions. They are making for virtually all companies that are selling here in India. FII and DI holding has increased. FII have bought more from around 5% to around 11-12% of DII, sorry, FII holding has increased over the last 6-7 quarters. There's only 8% free float, and the major portion of the you can say stocks are with HNIs or FII, DIIs, etc. Okay, so this is why I am so positive, and let's go by this one by one. Although this video could be a little longer, but you need to understand as to how the business is at 8,000 rupees, and this company trading at something like 90 times earnings at the current levels, but still it looks very attractive. So strong clients in many domains. So they have, as I mentioned, Samsung, etc., as clients in the mobile phones domain, Xiaomi in televisions, and Mi TV, the smart televisions of Xiaomi is selling a lot. Chinese or no Chinese company, it has been selling a lot over the years. and has been doing coming from a different route. They have roped in other clients as well. They have not mentioned the name of the client, but they have roped in other clients in the mobile phone domain. There is still speculation going on as to which that company is, but they have told that it is a huge client that they have roped in for whom they'll be making product probably from next quarter. There is heavy institutional HNI investment, as I said, and that has increased. So FII investments have increased over the last 2 quarters sharply from around 5-6% to around 12%. It has nearly doubled, and consumer durable and electronic business is in early stages here in India, and there is strong demand. And basically what has happened is during the lockdown and all these period, the demand has slowed down to abysmal levels, and the stock did fall a lot to around 3,000 3,200. But look at the sharp recovery, and the recovery only took place because the management itself is very positive and saying that they are going to have very good numbers for the September, very decent number for the September quarter, and a huge Diwali for December. So the Diwali quarter would be big, and they are back to normalization in terms of sales and in terms of production, and that is why the stock is really surging. Electrification is also a big help in this business, electrification of India, and it is still a small cap. Even at 8-9 thousand crore market cap company, it is a small cap company, one that can be bought even now, and considered as it can become a decent mid cap. It is a big play on higher middle class consumption. People are looking to buy bigger television sets, people are looking to buy better phones, and this just continues. Although there was a little bit of, you can say, repetition, little bit of stalling of this over the last quarter, but I think it's coming back to normal now. So why a buy? I believe that why it is a buy even after the surge. This is the reasons why, and I have gone through their conference call after the Q1 numbers. I've gone through 2 or 3 of their interviews on television, and this is what I have come up with, the crux of it. And a standard disclaimer that I have bought into the company, so that's a disclaimer. Prospects of gaining large clients in mobile and television space, that they have told they have already roped in a large big client in the mobile domain, and they're told that in the TV space they are making it for Xiaomi and other television like Samsung, etc. Set top business alone to bring in 1,000 crore from FY22. Now this is big, and this has been categorically pointed out by the management in their interviews, that the set top business will be categorized as a different business category, just like washing machines, just like mobile phones and LED televisions. There will be a space for set top boxes, and described as how many they sell, and they are making it for Reliance Jio. So this is a direct play on the Jio space. Very few companies that you'll find that you'll have a play on the Jio space. 250 crores quarterly and 1,000 crores yearly. Dixon does quarterly sales of around 11-1200 crores. So you add another 250 crores for no extra thing. I think they do 13 to 1500 crores. So 250 crores added up, they would end up doing at least 1600 to 1800 crore sales quarterly from FY22. That is what it's saying, just on the fact that they'll sell more set top boxes. Then you have the expanded capacities in mobile and TV space by more than 60%. So what they have done is, their capacity was around 3 million units per year. They have increased it to 5.5, I think, from 3.4 to 5.5 million units per year. That is just tremendous that they have increased that. Also, they have also entered into the diagnostic space, which is a high margin business, and with Mobilio, as I explained, making the diagnostic kits. So that is also a huge positive. So as I explained, so expanding the capacities of mobile and TV phones and entering the diagnostic space is one of the biggest positives for the company. So you look at the kind of expansion that they are doing on all fronts, whether it's set-top boxes, televisions, mobile phones. as well as diagnostic kits. PLI scheme is a direct benefit. So whatever this PLI scheme has come out, it has come out as a breath of fresh air for electronic manufacturing and pharmaceutical companies, and they are believing that this is going to be a huge positive for the next 3 years, and that is why my investment horizon is at least 3 years into this stock. And you'll see the full potential of the company as to how they do it, because what they are going to get is they are going to get incentive, tax incentive, for selling a particular number of phones that they sell here in India after manufacturing it here in India for less than $200. That is what PLI scheme is all about for electronic manufacturing. So they are going to get tax benefits, they are going to get rebates over it, over selling the phones which is less than 15,000 rupees, and they make up for 30, around 30%, 30 to 35% of the Indian need of such phones. So that's how their market share is. Ban on import of LED televisions is a huge positive, because they have been manufacturing it here in India for a longer period of time, and now it is going to gain even more traction, because Dixon is one of the, or perhaps the leading company in making such product, and probably large LED manufacturers from abroad would sought Dixon's help in order to manufacture everything here, rather than exporting it or putting or selling it here in India, by exporting it into India. Some more reasons as to why I believe this could be big. They are looking to substantially increase export of less than $200 phones, as I explained. So not only manufacture it here in India, but they are looking to export it big time from FY23 onwards, globally. So they are going to be a global player, Dixon Technology, not just making products here in India and doing well. So basically what is happening with Dixon, and they told, the management told in their conference call, that they are at an inflection point. And why they are saying this is what happened with IT 20 years back, when IT started to export knowledge abroad, and with BPOs, etc. Not at the same scale, but in a similar vein, Dixon is doing here, by providing, you can say, mechanized, or you can say by providing in-house facilities for manufacturing all sorts of electronics. So you name it, from washing machines to dishwashers to even some microwaves. They do set-top boxes, they do, now they are going to get into diagnostic kits, mobile, so virtually tablets, etc. So many things they are doing, and they are expanding their base even further without hampering the balance sheet. That is the important point. They are not expanding like vehemently like the future group did, or the other, you can say, groups did, which faltered later on because of expansion and taking a lot of debt. Reasonable debt, low debt, and yet expanding on that. Yes, they give less dividend, but still the expansion is bringing in more profitability for the company, and hence increase in EPS. Ramp up in export of LED lights, and gaining more clients in the LED light space. Now this is also a space which is a decent margin business, and they make it for virtually all major companies in the LED light segment. So now you have this also as an electronic product that they are manufacturing. After expansion, looking to serve 35% of all TV requirements here in India. Now imagine, in a very very cutthroat competition of consumer durables and electronic space, a company having 35% market share of manufacturing, that is just huge. And that really takes the cake, and that is the most important pointer as to why I believe Dixon could be big, going forward, could be very big. If somebody can hold it for 10-15 years, if things go right, if you look at it, if you look at numbers and be fine, every 3 to 4 months you can check how the numbers have been and how the company is doing. If management is same and doing the same things, this could go big, going forward. Then they have told that the festive season this year to see pent up demand and strong numbers, and they have told this, that the festive season could be very interesting. And it by that time, in fact, they say that by July, things have started to become normal, and July, August, they believe that by August end everything will normalize. So I think this quarter of October to December will be big because they will be selling more products like more LED lights, televisions, set top boxes, and so on and so forth. The December quarter could be extremely interesting and largest player in making feature phones. So as I mentioned, that feature phone business or less than $200 business is doing extremely well for the company, and it is the largest company in manufacturing that. And if you consider that over the last you can say the first quarter, the business has really shrunk. All that demand would come through from say the December or the March quarter. So if somebody can just be patient with this company for 2 3 years and don't worry about losses for the next 6 months, it could go down. He could make a lot of money over the next 3 years. Valuations attractive as sales may surge to nearly 8,000 crore by FY22. So as I mentioned, 1,000 crore would come in from the Geo, you can say, set top box itself. They are doing currently, the company is doing between 5,000 to 5,500 crores. Straight away 1,000 crores from the set top business would take it to 6,500 crores. Expansion into the television mobile space by around 30 35% should take the should take the sales number closer to 8,000, at least 7,500, 7,000 to 7,500 by FY22. And if you take 3% or 2.7 or 3% roundabout that as margin, then around 200 crores, you can say, could be, I think 200 crores or so could be the net profit. So 2.73%. So you can imagine how the EPS would look like. If we look at the technicals of the stock, relatively under-owned stock, especially by retail investors, that's the first thing. And the more it has went up, the more retailers have sold, and HNIs and FIIs have bought into it. And this is one thing I want to tell everyone here: the stocks that become extremely expensive are good. They are not bad. Yet, yes, in the short term, or at least one or two of those stocks may just catapult. That is fine. But in the consumer space, if stocks are becoming expensive, uh, day by day or month on month, you have to look at numbers. You have to look at on the ground as to what is happening and whether it is sustainable or not. In Dixon's case, it looks very much sustainable, and that's why this can become expensive even more. I That is not to say you buy at 8,400, but the point is there are support levels, there are fall. We saw that fall in couple of days back in the stock, and then the recovery. So any 5 to 10% dip in the stock, you get in little bit, then again a fall will happen, you again get in and sit on it for 3 4 years. That could be the best strategy. So long term support is around 7,000. If you get it just around 7,000 7,500, get into it. 8,000 is a short term support. It has reversed from those levels a lot. Any corrections will be a huge buying opportunity for you, and it will see a huge breakout after 12,000. So I think between this 8,000 to 12,000 it can go over the next 6 8 months, but beyond 12,000 you could even see 18 19,000 coming in extremely quickly. So what needs to be done? Buy on major declines, as I explained, and major declines here means between 5 to 10%. Keep track of the numbers. Have a good 3 to 5 year time frame. It should be able to give consistent return. I don't know how much, but I am expecting that over the next 4 years it should be 3x from here. Somewhere there, little bit less or higher. So this was a video on Dixon technology. Please like and subscribe my channel. Hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.